Sum up your analysis of our fears of higher inflation.
Well, I think that there are fears, and I think that there's reality. And I actually think on this file, Powell's probably got it right. There's no doubt that in addition to the depressed base effects, we're going to have higher inflation readings for the next few months. But, the question is, as you said, is it a change in the fundamental trend line, or is this a deviation temporarily from the long-term trend line? And it's just human nature. Everybody just focuses on the here and now. You go back a year ago, and, we had negative CPI readings, and in fact, negative core CPI readings through most of the winter into the spring. Did that bring on sustained deflation? The answer is no. And now we have a situation, in contrast to a year ago, where the demand side clearly is coming back much faster than the supply side. But I think it's a faulty presumption to think that the supply side, as the economy reopens, is not going to come back with a lag. And that inflation is going to come right back down again. But the prints are going to be higher in the next few months. There's no doubt about it. I don't know why that would be a surprise to anybody. But I don't know how a pandemic, the first pandemic in a century, managed to change the entire debate from a disinflation or low inflation backdrop to somehow we're going into some pernicious inflationary backdrop. It's really tough for me to wrap my head around that. My sense is that, just as we had a demand-supply gap a year ago where demand plunged more than supply, we have the inverse right now. And I think this inflation narrative is going to last as long as the deflation narrative did exactly this time last year.
David, what has surprised you in this recovery?
Well, I'd say that, what has surprised me is the extent to which the risk on trade in the market, revived as dramatically as it did. Not that with the reopenings and the vaccines and the policy stimulus that, that we shouldn't have seen investor animal spirits come back. It's just that the magnitude. So if you're going to ask me, when I look at, say, the CAPE PE multiple, north of 36, did I think that we would actually gallop ahead this quickly to the highest multiples we've ever seen in the stock market outside of the dot-com bubble? The answer is no. So to me, it's been more the magnitude of the euphoria in the marketplace more than anything else that's really surprised me.
That's fascinating, because other people would say it's the magnitude of the actual earnings of some of the fundamentals of these companies that has surprised a lot of people to the upside, which is why we were just speaking with Jonathan Golub of Credit Suisse about upgrading the S&P forecast to 4,600. David, what would you say to people who say the fundamentals justify the growth expectations that have been baked into market valuations, given the amount of money being printed in combination with the Treasury and the Federal Reserve?
Well, actually, when you're taking a look at earnings estimates, say, for the end of this year and then of next year, they're really bringing us back to the levels that the consensus was pricing in at the start of 2020. So, this notion that companies are radically beating down estimates, I get that. I mean, what quarter do we ever see where companies aren't they're beating down estimates? And this time, it's clearly a record, but the level of earnings themselves, when you're taking a look at today's estimates for the end of, say, this year and next year, aren't that much different than they were at the beginning of last year, and the market has ripped, 30% from those levels. So, look, the reality is this. I'm not looking at the trailing multiple. Let's look at the forward multiple, because the forward multiple incorporates what you were just saying, which is this dramatic increase in earnings expectations. The forward multiple is like 22, 23 times earnings, which is 40% above the historical norm. And you can't rest on the fact that, interest rates are at microscopic levels, because they're not where they were, say, 6 or 9 months ago. So they're quite a bit higher. So I'm just saying that even when you incorporate those earnings expectations, this market really is valued for perfection, and then some.
Okay, but then, David, if we get the Rosenberg inflation call, the reticence that I hear, how will that fold directly into the equity market come the end of summer, come early autumn?
Well, I think that it's more, where do you want to be invested? In my forecast is basically that we're going to have a fiscal cliff that we're going to fall off of. I don't know why most estimates don't incorporate the fact that so much of this, not just the inflation, but the growth. I mean, everybody's waxing about the 20% increase in incomes in March that we cut on Friday. 95% of that wasn't organic income. It was basically, gift from the gods in Washington. 95% were income transfers from Uncle Sam. A lot of this rolls off in the second half of the year. So it'll be interesting to see how the economy stands on its own two legs, even with the reopenings, when you consider the massive fiscal withdrawal we're going to see. And so maybe you have an assumption that, well, just the Biden team will continue to roll out fiscal stimulus with the perpetuity. I'm not in that camp. So I think there's going to be tremendous fiscal withdrawal by the fourth quarter. And so I don't think tapering by the Fed is the critical risk. I think it's going to be that earnings and economic estimates going into the end of the year are going to come down. I think we're going to have a bull flattening in the Treasury curve. I know that's anti-consensus. But I think that means that in the equity market, I mean, really, who knows? Jonathan Golub might end up being right. Who knows where the stock market's going to go? It's gone much further than I thought it was going to go. So let's just say that if my forecast of a bull flattener and reduced growth estimates come to fruition, where you don't want to be in the cyclical trade anymore. You really want to be in growth and defensive growth. That's the segment of the market that should outperform.